Hey everyone, want to take a couple minutes here and just jump through some of the new features of DealWorthIt 2.0. So as you can see here, the dashboard looks a little bit different. We cleaned this up a little bit, made a couple more statistics up there for you to be able to track. We have a deal finder that is built into DealWorthIt, so you're able to filter out by a bunch of different filters to really narrow down based on your specific market. The deal pipeline also cleaned up, so you're able to drag and drop properties, wherever they are within your portfolio. So great to have that. We also have a report section, so you can generate reports based on your deals. You can do this from your deal, and then all your reports will be populated within here. You can do some market analytics, so deep diving kind of into those markets. Milwaukee, for example, just moved out of there, but you can kind of see what some of these market statistics are. You can go through and analyze a deal, get some comps, and see what deals you've actually been underwriting within that market. So really great to have a lot of this data just really available for you. One of the best features I'm going to show you is one of these fantastic assets that we've been able to add to DealWorthIt here, where we're actually able to upload our rent roll and T12 directly in as just those raw files, and you're able to just continue to underwrite based on those files that you've added. So just going off of this deal, for example, let's call it 123 Van Beck Street, 265 units. Say the purchase price of this is $35 million, the larger multifamily deal. What this actually does is it goes through and it processes what those spreadsheets have on there, right? So it excludes data that's not really relevant, like titles and total columns and things like that. And it actually picks up those individual items. Because these rent rolls and T12s a little bit longer, may take a couple seconds to process that, but on a 10, 15, 20 unit deal, it's a pretty quick process for the back end to analyze and go through that and parse that data out. So you'll see once these are uploaded and as they go through this process, all of the data that's going to be included. And then if there's something specifically you don't want included, you can actually exclude that from the import. So let's go right into this. We're going to review it in the workspace. Obviously, this isn't the actual address of the property. It's just something I typed in here for the demo purpose. But what you can see now is we've imported this rent roll. So very important when you import your rent roll to be able to see what the current occupancy is and then what they're capturing compared to what the market rent is. So we imported this T12. There's 265 units. It shows us right up here, 244 occupied, 21 vacant. It also shows you how many leases are expiring within the next 90 days. So doing a lease audit, it's great to see that data specifically. You can click on them. You can see who these people are, what's delinquent, who's paying above market rent, who doesn't have some market rent, who's paying below market rent. As you can see, this is a pretty old T12. A lot of these have already expired, but I just wanted to be able to show you this as we go through. And we're going to import that. And what that's going to do is it's going to update just the income column there. So what that rental income's coming in. Just a rental income. Now, as we review the T12, we're going to actually have a bunch of other things. So you can see 127 items are going to be imported here. There's a couple things it's not going to import here. These are the total columns, some operating expense total columns. And what it does is it doesn't import, certain aspects there. And if you want to include something or exclude something like loss to lease, we can exclude that. It's not something that needs to be in here. If this is employee units, we can include it. We cannot include it. You can go through and just make sure that everything's categorized. The system does a great job of really evaluating a lot of these things and putting it in the correct category, but it's always good to review the data before you import it. And then what we're going to do is we're just going to say, hey, look, I understand it's not going to import this certain data. And then we're going to improve that import. And just like that, we have all of our income and our expenses already put into this deal. So just kind of going through here, you can set up your own defaults here. So one of the things we can do is set up our own deal assumptions. So as we do that, we can see, we have a down payment of 30%, interest rate at 6, 25-year M. We can go through and see what projections, what our hold period is. And all of this is just going to be like your typical data. So just something like your baseline to start the deal. And as you go through, you can go line by line. As you can see, we imported the rent roll. All of that data is in there. We imported the other income. It took all 27 lines from the other income. The vacancy, delinquency, you can adjust these sliders. So, maybe it's 95% occupied. Maybe we have a little bit of delinquency there. Maybe the concessions are burning off. That was just a lease up and we want to move that slider, back and forth. The other thing that you can do is I'll jump in a little bit deeper a little bit later, but you can adjust all of these things. If you don't have a T12 and you just want to do, fixed debt or fixed expenses or a percentage of the operating income, you can break it down that way or by per unit. So we're able to add those expense items kind of as we go through there. But this was imported directly from the T12. We also have the tax reassessment. So if you know your tax rate for the area, you're able to predict what your taxes may be in the future there. So one of the greatest things here that I certainly love is you can set up your loan assumptions, what these minimums would be. But when you're actually in the loan, if you don't have access to this data or you don't understand where to even capture this data, you can actually click right here and view the market rates. So say we're looking at a bridge loan, we would use that SOFR rate, right? Maybe we're looking at permanent debt, 5-year, maybe we use the 10-year, but you can actually adjust what the lender spread is. So if this is Class A, beautiful new construction, you may be a spread of 1.5 or 1.75 points, and we can actually plug that rate directly in here. Maybe this is a 10-year loan instead of a 25-year loan. Maybe we have 60 months of interest only, and we can go through and we can adjust these LTVs. So, if this is 65, it'll automatically adjust this down, to 35, and you're going to bring in 12 million equity to this deal. We also have suggested loan terms. You can go in there, you can see what a 30-year loan, you can apply it directly into the underwriting as you're going through this. Just for ease, I'm going to show you exactly what we did there. And then you can go through and continue to modify these things either by, say, dollar value. If you know your closing costs are, X amount of dollars, you can put it in there. If you're just doing a quick estimate, you can go, okay, we're going to put in, 3% of that. If we have to prepay taxes or prepay insurance, we could put that in the closing costs as well. If you do have some CapEx projects, say you're doing, just general improvements, maybe you're doing on a per unit basis. We're going to improve 130 of these units and we're going to put in, $5,000 a door. We can add that CapEx. We can say if it's financed or not financed. And another awesome part within the CapEx here is that we can actually do a draw schedule. So we can say, we want most of this done up front. We want this evenly split on a year. We want to front load most of this. A lot of the units we'll do in the beginning, and then we'll see if we're going to be capturing that. If we're not, we may stop that business plan. But what we're going to do is be able to save and kind of allocate along the way. I thought that was a really awesome feature. And then again, reserves, we can go in with our replacement reserves. These are required by the lender. We can put some reserves in there. We can also put a closing reserve. So say, we want just a little bit of operating reserve. If the kind of, in case something happens types of fund, if we need a little bit of escrow money, whatever the lender is requiring, on that closing. And then we have our growth and exit assumptions. So if you're going to do a value add, say you're going to do a one-time rent increase across 150 of the units, and that's going to be a $150 a month rent premium, and maybe that starts month 13 after we've done some of those renovations. You can add that one-time value add in here. You can add another one, for example, if you're going to do pet rent. Maybe 100 of the units have pets and they've never been charging that, and you can implement that within the first quarter of this deal. We can add that one-time value add. That's not going to go with our projections where we may have our income or expense inflation. These are going to be one-time things with that forced appreciation. So maybe in here, being ultra conservative, 1% increase on the income of the property, and maybe we do like a 2.5% expense inflation, just showing that, the properties, it may cost more to operate, and we're not anticipating big rent growth just because of how the market has been. You can also do your stabilized occupancy, and you can break that down to what you consider stabilized. So maybe we're 92% for year one, and then we increase that, a couple percentage points, and it'll let you know here that, we've manually overrode the schedule. But you're able to go through and really break these things down granularly across here. So, the old Deal Worth It didn't have stuff like this. We have a lease up, ramp up period. So if you're going from, say, hey, we're going to start, our starting occupancy is 92%, and our stabilized occupancy, we'll likely never see this, but, say it's a 98% is our stabilized. We can actually do that, linearly through this, and that break it down over this 12-month period, and it'll put that boost in on that monthly basis. If we're going to do a refi, you can say, hey, refi year 5, here's the metric, here's the terms. You can drop that down, see what the refi summary would be. This would be a great refi, getting $10 million of our $14 million back. And you could also pop open the projections, and those are really, really great because you get all of this data on top, kind of those big metrics, and then you can go through and you can take some of this data and you can put this into your pitch decks and your offering memorandums, right? You can go through and really break this data down granularly. You can work through your sales assumptions, going through the sales summary, what this deal looks like it's going to make net proceeds wise, and we can go through and even added this this awesome feature. As most of you know, in the multifamily space, you generally want to see a sensitivity analysis. So we're able to mess with some of these sensitivities and see what output we're trying to, calculate for with this sensitivity analysis. So we can do a couple different versions of it. The IRR version, optimize for equity multiple, or the value at exit. We can go through and we can change what this what this table is going to show us. Again, something that's awesome that you can throw within your underwriting. The other piece, if you're syndicating, you can create these syndications. We did have this in the past. It's an 80-20 split. But here's a new feature, is you're actually able to break some of these fees down a little bit more visually. And it just makes this process a little bit nicer. And I think it's more streamlined. So if you have, one partner is 50%, you got another partner that's going to come in, maybe they're, 20%, you got another partner coming in for 20%, and then you got a fourth person that's coming in for 10%, you can actually put, this person's going to put in 500,000. This co-general partner, they're going to put in 150,000. This KP, they're not going to put in anything. They're just signing on the loan. But maybe you got another silent partner who's got 350 they're putting into the deal. And what it does is it pulls it away from the total equity, and it's showing you that, for LP dollars coming in, there's 13.1 million. The sponsors are putting in $1 million. And then when you go into here, you can actually break these down and add multiple member classes. So say your first group is a pref only group. Maybe they're coming in a pref only. They get a 10 pref on the deal, but they're only pref, no equity upside. Your next group, they may be, a larger investment class. Maybe they're doing a 6 pref, but they're also getting equity. And then your final class here, those guys have no pref, but they're all equity. So you're able to break that down, and we're actually able to save it either to the deal or as a template if this is like your standard distribution schedule. And when you go through and you break that out, you actually get all of this data that's showing you exactly what each person is going to be putting in and getting back. So it's something that's awesome to see just broken down visually, but you can also go into these investor projections and you get to pull out a lot more data here as well. So it looks like from this projection, this might not be a great deal, going into it, but we get to look here and break all of this data down and have these visuals, and it's just something that you're able to share with your investors coming into the deal and put together your deck. So we've now gone through really adding everything into the underwriting. It's only been a few minutes and we've been able to do that. we have this sidebar analysis that we can pull up as well, show you, you know, what the NOI is, what the debt service coverage ratio is, our free cash flow, some metrics here. We can set what we want our key ratios to be, but we can also show the math. So if you're trying to figure out, you know, where they got this number from, you could pop into here and see exactly what this is coming from, right? We can go into our debt service coverage ratio. So if you're not a person who really like understands some of these data points, this is actually helping you understand where it's calculated, why it's calculated, and how it's calculated. As we move further through this, we've now underwritten the scenario. We can duplicate this scenario. We can duplicate the main one or start with a blank one, and it'll import all of this data into that next scenario. We can pop into the report section, and this is a great report that you can download, and it's something that comes out as a PDF. You can see exactly, you know, all of the big data points here. Obviously, this isn't the right address. We just picked one randomly, but you can go through and you can see your IRR, that's pretty low. Your equity multiple, again, pretty low. Going in cap rate, decent. But you can go through and see all of these metrics as we continue to scroll down here on the report. And we have all of the data here for you broken down granularly so that you can make the best investment decisions. And you can see, like, look, it's going to give you a little bit of data here, right? In your analysis. Boom. Look at that. You can see that it's giving you an alert right there that the IRR falls below the preferred return. So they're probably not going to make any money. And we're also give you a deal score here, right? Like 55 out of 100. Not really a fantastic deal. You know, you want to be in the 80% range to be able to kind of give this deal a little bit more deeper dive or further analysis. So what we've done is we've evaluated it pretty granularly, but we can go in and make some other adjustments along the way, and it'll track all of that information. The other thing is we have this property data piece. So obviously this is a home, right? It's not a multifamily property. We did just pick a random address, but it breaks down all of the data for you. You know, the mortgages that are on the property, some of the equity, the current debt, when it's sold, who it's sold to, the location broken down with its APN, what schools are around it. So all of this information is available for you directly within the underwriting analysis. And then we also have a market analysis. And we'll tell you right now, hey, we have medium confidence in this market data, right? Like it's based on this, we have 75% of the public data that we're able to capture for this area. Milwaukee's a pretty big city, county, so we're able to cover most of it there. Some of these are 100, some of these are less. If you're in a small town in kind of the middle of nowhere, you may not have all the data available for you. But if you're in, you know, a primary or secondary market, you should generally be able to see a lot of the data that's coming through here. And one of the things that we can see is like, look, it's a pretty strong market. You know, verify your local comparable, but not a lot of material risk based on the data. But what we can see is like, look, the population's going down a little bit. Employment's going up a little bit. The rent growth is going up a little bit. But the problem that we're having here is we have limited employment data. So from that, we're able to give you certain suggestions. It can give you some underwriting guidance. You know, your rent growth may be 2 to 3%. Your expense growth may be 3 to 4%. Your vacancy may need to be between 5 and 7%. And as you can see, we had put 1%, you know, as our rent growth earlier, right? We put 1%, but this is saying maybe it's worth looking at 2.5. Your vacancy was at 5. It's probably worth looking at 6. Expense growth 2.5 we did. Well, they're saying 3.5. So it's good to have these data points. And what we can see is like bumping the rent from 1% growth to 2.5% growth bumps the IRR pretty significantly on this deal. And we're actually able to apply these market assumptions if you wanted to. You can apply them to the deal and it'll re-underwrite the deal with these new market assumptions. So it's great to have all of this data there. You can also go through and see what rent is going for in the area, some of these HUD benchmarks. So you can go through and kind of see, you know, are you on track compared to where your average rent is? We do have some nearby competition if there's stuff for sale, and what this score is broken down, right? We're missing some of the employment data there, so that's why it's not, you know, that 100%, but we're able to give you where this data was coming from, exactly what kind of data it's pulling. And then as we go through, you're able to see, hey, this is where they got the data from. Here's some of those market trends. Here's what the employee and the economy kind of looks like. What jobs are thriving, what jobs are going down, and then some of the other demographic data available here. So we give you a lot more data here at Deal Worth It. And the 2.0 version, I got to tell you, this is fantastic. As you go through, you can really see, we flag some things for you. We really made this a much easier process for you to fully evaluate a deal. And going through this whole process of underwriting at a really, really high level, you've been able to, I think we've been recording, 10 minutes here, and I've been able to go through a lot of the new features that are here, but also we've been able to evaluate this deal and know that, like, look, this probably isn't worth the price that they're asking for. So really excited about Deal Worth It 2.0. I think there's a lot of fantastic updates here, and you're going to get a lot of value if you're in the multifamily space, if you're in a self-storage space, even if you're in the single family space. There's